Let me now bring on board Mahesh Nadankar, India strategist with the CLSA. He joins us from Hong Kong. Mahesh, good morning. Thank you for joining us. Mahesh, if I map how Indian markets have moved in the last 3 months, it's only on account of liquidity. So what is your house view when it comes to Indian markets? Do you think it's a matter of time fundamentals will haunt us?
One of the reasons why we believe market has rallied over the last few months is partly attributable to the influx of liquidity, especially from the foreign institutional investors. Fundamentally speaking, we haven't really seen much of an improvement in the economic level or the corporate performance. We continue to see corporate earnings getting downgraded. Although one might say that the positive way of looking at this is the rate at which the corporate earnings are getting downgraded has slowed down a bit. So over the period of last couple of months, we have seen the corporate earnings getting downgraded by just about a little over 1%, which is much better than what we have seen in the previous 12 months or so. But having said that, it's still an earnings downgrade. So that goes to show that the corporate earnings still continue to be under pressure. The macro isn't giving us any reason to be bullish. So I would be cautious on the markets going forward. And I would believe that much of the rally that had to be seen this year is already in the bag.
So do you expect the Indian markets to trade in a range with push and pulls of policy paralysis, investment slowdown on one hand and global liquidity on the other?
Yeah, that is true. There has always been some expectations on the policy front, and we have seen several disappointments on that front as we go. Ever since in the beginning of this calendar year, there was some expectation about some accelerated resolution on the fuel supply issue, etc., which have got partly been addressed, but not to the satisfaction of the market, I would say. And then there are some other issues like the subsidies and therefore the fuel price rises, etc. So those have still not happened. We're still waiting to see those. So yes, there is some hope definitely, but that hope, I would say, has been belied so far. So as you rightly mentioned, yes, it's going to be a push and pull between the liquidity factors and the fundamental factors.
Mahesh, what do you expect to hear from Fed later tonight? QE3, or it may not be QE3, but for sure we will get a innovative form of quantitative easing?
Well, I'm not actually a global expert, but our global strategist and our internal think tank believes that there's a good chance that some liquidity related event, be it in the US or be it in Europe, might happen. And that would definitely be a positive for all the emerging markets, including India. But having said that, a part of that event has already been factored in, which I believe is one of the reasons why we have seen this flux of liquidity coming into the Indian stock markets. So we'll not be too enthused about it, but yes, it will be a mild positive. That's the way I would put it.
Mahesh, in your recent note, you mentioned that the next 2 years would be fairly challenging. Do you expect a turnaround in the Indian economy only in 2014? And meanwhile, how do you expect the markets to behave?
Well, what we have also recently highlighted is one of the big reasons why we are seeing the investment slowdown is also cyclical. While a lot has been talked about the government's policy paralysis, our own analysis suggests that a large part of the current downturn is cyclical, which is going to take some time to correct. We need to see the corporate margins moving up, the corporate ROEs moving up before we begin to see the upturn. So our point of view over there is that even if you see the government moving swiftly on some of these policy related issues that we talked about, we're still going to take 12 to 18 months at least for the numbers to start showing up on the corporate profitability side, and it's only then can the next leg up will actually come into a comment at the market level.
Mahesh, what makes CLSA underweight on industrial plays? Because that's where deep value is, and that's where if the cycle reverses, big gains or big money could be made.
Yeah, so as I said, we have seen the investment pace growing at a very rapid rate of around 35% CAGR in run-up to the GFC, that is between 2004 and 2008-2009. And that indeed ended up creating large capacities in some of the manufacturing sectors such as steel and cement and autos and refining petrochemicals, etc. So that process of excess investments had to get corrected, which is what we are seeing at this point in time. So that's the reason why we believe that the next leg of investment cycle will happen when some of these corrections happen, and which we believe will be about 12 to 18 months away. The other factor that is going to impact the investment cycle mechanism is also the fact that most of the capital intensive businesses or corporate houses that drove up the investment cycle to start with are now in a risk averse mode, and they are trying to contract the balance sheet by selling off assets, raising private equity and so on. So this process of deleveraging also will be the other time consuming factor, and which is the reason why we believe that the investment upturn is still some time away and therefore still too early to jump into some of the stocks in the industrial space.
Mahesh, so at your conference, what is your message to investors? Are you advising them to play it safe and remain with the defensives, or are you telling them to start nibbling in at some of the likely gainers of the slow industrial upcycle?
Yeah, so what we are suggesting is a balanced or a cautious approach. We have overweight stance on some of the defensive sectors, as you said, such as pharmaceuticals. But at the same time, we are also asking investors to start looking at some stocks which we classify as shadow defensives. And what we mean by that is cyclical stocks with good quality management, good quality corporate governance, etc. We believe that private banks actually fit into that theme of shadow defensives. So we are asking investors to start looking at those sectors as well.
Mahesh, stocks and ideas you are bullish on, and at the CLSA Hong Kong conference, which are the companies which have impressed you?
Well, our top 5 ideas, as I mentioned, is actually a good mix of the defensives and also the shadow defensives, as I said. Those include ICICI Bank and Axis Bank in the private banking space. And then on the defensive side, I would say Power Grid, which is the T&D utility. We also like BPCL, that's the oil and gas company, state-owned oil and gas company, which is transforming its business from downstream to upstream now. And we also like Lupin, that's been our top pick from the healthcare sector.
So do you think the current slowdown could trickle down to consumers too, and is that a possibility? And if yes, then doesn't steep valuations make them risky space to be in right now?
Oh, certainly it does. And in fact, that's one of the reasons why we have an underweight stance on the consumer staples. We believe that consumer staples sector, which has held up so nicely, both in terms of the fundamental performance and obviously the stock prices reflect that quite nicely. But we believe that when so many segments of economy are slowing down, it's difficult for just one segment to stand up against all odds. And our own analysis suggests that there is a correlation between the consumer staples growth and the nominal GDP growth, which shows probably with a lag. And going forward, we believe that there needs to be some moderation